Good afternoon, everyone, and welcome to this quarter's FI Live series. The format of the series today will be mostly similar to what we've had in prior quarters. We will have an update of what's going on in the market, some peer analysis, and look at financial trends, talk about some liquidity and funding strategies, and then share a few tools and products that we have offer here at the bank that you have access to. A few housekeeping items. This is being recorded. A copy of the slides and a replay link will be sent following the webinar today. You can use the Q&A function to submit questions, and we'll get to those kind of as we go or touch on those at the end. Also, there is one CPE credit that is available for today, and to receive that credit, you must participate in the polling questions that we have throughout today. Difference today is we do have a special guest joining us. Zachary Thompson, a collateral review officer here at the bank, is joining us to share best practices related to pledging collateral management, and then share insights on what he is seeing and hearing on the road. And to start off with, we have a poll question asking which area of the webinar are you most excited about today? And we will give you all a few moments here to respond to that question, and then Drew will get us started off with an economic update. Before I go ahead, have most of the participants. And we got a mixed bag here, so we'll make sure we'll cover all topics for you today. And we'll get started with our economic update.
Thank you, Leslie. Well, I hope everyone made it through the Labor Day okay, and probably got all your kids back to school. And we've got a little bit of a changing of the mindset from the Fed. We've got some dovish sentiment from Chairman Powell, and we've also got some changing of the economic numbers nationally. So wanted to cover that with you guys today. If you have any questions, as always, feel free to use that Q&A, send us direct messages, anything you'd like us to expand on or cover further. So, starting with inflation and where the Fed is at insofar as their meeting later this month. Inflation, core inflation's moderately higher, not much change from the last quarter. And the Fed is clearly hinting at some rate cuts. GDP did increase, however, along this quarter-over-quarter revision, and core PCE, like I said, inched up a little higher, 2.9%. As did core CPI at 3.1%. The unemployment rate is still effectively the same, although we've got a little bit more detail in the jobs data insofar as some slowing when it comes to payroll growth. You can see that there. Home prices have continued to come down. Year over year continues to come down on HPI. Case-Shiller is showing home prices coming down. But the big challenge right now, and has been so for a couple of years, is home affordability. You can see here on this chart on the right, basically showing what we are seeing when it comes to affordability comparing buying versus renting. Okay, so if that ratio is above that line there, you can see what that premium is historically as well as projected in the current level. So right now at 101% on a percentage basis, that means that it doesn't really make sense for most households to buy a house versus rent a house. And that has to do with interest rates. It has to do with home prices, although they're coming down, and hopefully that'll change. So we've heard also from Secretary Bessent recently talking about those challenges, and I'll cover that here in a little bit. Well, let's first begin with the Fed. After the Jackson Hole meeting, he was quoted as saying the shifting balance of risks may warrant adjusting our policy stance. There was some other sentiment, other things that were said during that meeting that seems to suggest a September rate cut is likely. Right now it stands at about 87%, or at least that was as of Friday of last week. And so it's pretty likely we'll see that. Moving forward, uncertainty. I think the market is really looking at this just one foot in front of the other. And that's because, we started with a big 50 basis point rate cut, paused for a little bit, another 25 cut. And then, here we are about 100 basis points off of the 5.5 level where they peaked off at, but not your traditional easing policy, right? These last few easing cycles have been pretty consistent. Big cuts, consistent cuts, meeting after meeting, off meeting cuts even, but that hasn't been the case here. And that's why the longer end of the curve isn't responding like it has in prior cycles. So we'll cover that here in a little bit. But speaking of which, let's just go ahead and poll the room here on what your anticipations are for the Fed rate cuts this year. 0, meaning no more cuts. 25, maybe just one cut this month and ride it out for the rest of the year, or one cut maybe in the following meeting. 50, 75, or more than 100 basis points of cuts. And lastly, no, we're actually going to see a rate hike. So I'll go ahead and share those results with you. Did they pop up on the screen there, Leslie? Okay, there we go. Let's let those questions filter in here. Looks okay, a little bit of lag. Let you put those in and share the results. You can see on your screen, if you want to move that window around to where we were last time, and I'll cover that as well. Okay, looks like most of you have brought in your answers here. Yeah, we're split almost 50-50 between either a 50 basis point rate cut or a 25 basis point rate cut. So does it mean 150? Does it mean 225s if you're on the 50 camp? It remains to be seen. Looks like only one person thinks as much as 75 basis point of cuts for the remainder of the year. Okay, second poll question. When do you think the next recession might begin? It's already started. You think the writing's already on the wall, and we're just lagging the economic data here. Second half of the year, beginning next year, 2027, or really no recession in sight as far as you're concerned, and we might pull off a successful soft landing. Obviously, that's what the Fed wants, but it remains to be seen if that is what they will be able to accomplish. Okay, go ahead and open that poll up. Oh,
it was already open. I have to answer the first one again.
Oh, okay. Looks like people are answering the first one again.
Well,
So, okay.
in the poll here, and then we can see the results.
Yeah, just there we go. So about 44% of you think 2026. So we're looking at about half the room, not until next year. A few of you maybe as quickly as this year. And then a handful think that maybe no recession is in sight. I think the big thing that just really hasn't, or that it's probably had the Fed hesitant of cutting rates is the jobs picture. And we'll cover that here in a little bit. Okay, moving right along. So GDP. So pretty big increase from certainly from Q1 and then from the prior revisions. The biggest component here that you can see, the shaded bars there. There's a chart up there for you to tell you what each portion of GDP represents. Is net exports. Certainly a big portion of the GDP print came from net exports. We haven't really seen that in quite a while, especially over the pandemic through the last couple of years. Net exports was a big factor in that. The biggest drag on GDP, so anything under that 0% line there, how much of a percentage point it represent, would be the change in private inventory. So net exports can ebb and flow. Sometimes there's some seasonal adjustments there, but either way, from a growth standpoint, very good numbers. And we'll see what the next few revisions will show. Core PCE, again, this is the Fed's preferred measure of inflation, has really just been bouncing right under that 3% level. Historically, there's that magical 2% level that the Fed wants, but many have talked about, is that just a representation of these prior economic cycles where we've had massive contractions? Do we really need to look at something closer to it at 2.25%, 2.5% level in this type of market where, we might not see the types of moves the Fed has prior, made when it comes to cutting rates all the way down to, ZIRP type policies, right? Zero interest rate policy. A lot of folks think that that's not going to be the case this time around. And so far, we really haven't seen it, nearly what the inflation was just a couple of years ago. So we're certainly moderated there. But the long end of the bond market, PCE, CPI, all these numbers are really kind of holding within a range over the last few prints. Okay, so the bad news when it comes to the job market is some revisions to the numbers, as well as numbers that even came out today, or looking at some of what we might have seen already in August, some of the early print. But either way, when it comes to the June and May data, they were only averaging about 35,000 a month. May, June, and July. That's very, very low. That's the lowest amount that we've seen since the pandemic. Again, these are revised numbers, and they go back through, they look at some seasonal adjustments, they look at a lot of things here. But either way, I think that is probably what moved the needle when it came to the Fed's discussion in Jackson Hole. Home prices continue to fall. This is just a longer term chart going back to 2017. You can see that, you rarely see, big, figures in the red here. Obviously, we saw it following the pandemic and the recovery as a result. If we took this chart, of course, back to the 2008 crisis, we'd see really red figures for a while. We see that was a housing led recession. But this is in a lot of folks' minds necessary. With the stubbornness of interest rates, especially in the long end, affordability problems, and maybe a little bit of irrational exuberance when it came to home buying, when interest rates were low, but following the pandemic, and that continued. So you had a lot of FOMO, you had a lot of people, I got to buy a house. And then things slowed as the affordability problem reached further and further into the retail space. Okay, I titled this slide Renter's Nation because what we're seeing here, I'm going to start with, first of all, the chart on the left. The chart on the left is very similar to my first chart that I showed, just showing it in dollars. How much in actual dollars is it more expensive to purchase than rent? So that dark blue line that you see right there in the middle of your screen, the national average is, sure enough, an extra $1,000 a month for the average purchaser of a home versus renter of a home. And you can see that in what's driving those figures insofar as multifamily versus single family starts over there to the right. Usually in a healthy market, we want more single family starts than multifamily starts, but we're seeing a divergence in that trajectory. Okay, so you can see here to the right hand side of your screen, multifamily in red has really shot up over the last few prints, while single family has been precipitously coming down. We don't want that. We don't want corporate sort of buying the way we've seen. It's not healthy for an average household. We want to see more households in the market. Of course, we are trying to be at the forefront of that, coming up with new solutions. You've seen some of our newer products, most recently the mortgage rate reduction program. Anything we can do to try and help those borrowers that are on the cusps of buying a home. And here are the figures just when it comes to affordability. And this was from the National Association of Realtors last month, showing that the average, the average buyer in the United States data here, only 28% can afford a home. Okay, so less than a third of buyers right now, or of those potential homeowners can afford a home right now. That's incredibly detrimental to a healthy economy overall. We want to see more home buyers. Only 28% can currently afford a home based on these levels. I just picked some of the cities that were in that data set that were in our district, Oklahoma City, 40%, much better, certainly. Kansas City, much better than the national average at 34%. Any of you folks in the Colorado area, you know that the Denver market's always been a challenge, and sure enough, it's even lower than the national average at 19%. So we'll see if there are any more policies coming through the new administration, anything that can help move the needle there. Certainly, everybody's eyes is on interest rates and home prices to see where those moderated levels will be. A lot of talk has been around, anywhere to a 5.5% or lower handle is going to invite not only more home buyers into the space, but probably going to have a pop in refinance activity for the folks that have bought homes in just the last few years. They're going to see as much as probably a 200 basis point reduction in their interest expense on their mortgage. So lastly, I'll talk about rates before I'll kick it off to Leslie, and we'll do a little member trend overview. This is just looking at the average 30-year mortgage rate using bankrate.com data going back just over the last year relative to the Treasury curve, the 10-year, and then that's going to be in blue. And then I put in the Fed funds rate down below. So you can see that, anyone who's in the mortgage market knows that the 30-year mortgage rate generally is highly correlated with the movement in the 10-year part of the curve. But what's interesting here is that, going to this next slide, right? Going back to 1999, as far back as the data went for the mortgage data, you see some pretty correlated moves, right? But if I go back to this last slide, as the Fed was cutting 50 basis points in the first cut, another 50 and another 50, the 10-year part of the curve and mortgage rates just continue to go up. Right. So that means the long end of the curve isn't buying really what the Fed is doing, or they don't have faith that this is a true easing policy. And they were right, because we've flatlined ever since. We started the year thinking, okay, maybe we'll have 6, 7 cuts, 8 cuts, maybe. Highly likely that we're going to get this big number of cuts, because the last few cycles when it came to easing, that's what happened. They just continued meeting after meeting lowering rates. But this time we're just not seeing enough weakness in the economy to justify the Fed lowering rates at such an aggressive level. The other thing to note in this slide here is that the spread relationship between the 10-year Treasury and 30-year mortgage rates, on average, going back to 1999, is about 186 basis points, okay? If you take the spread, however, just in the last, 3 years, which basically is the time frame in which mortgage rates exceeded 5%, continued to climb. Okay, it got as high as, 7 3/4 maybe in late 2023. The spread differential between that green line, which is mortgage rates, and the blue shaded line, which is the 10-year Treasury, has shot up to 292 basis points, dang near, well over 100 basis points differential from the longer term average. And again, I think that the reason for that is that we're just not seeing much faith in the bond market that whatever the Fed is doing is going to significantly lower inflation on a longer term perspective. Most of that might have already been baked in. That core PCE is just under 3%. Maybe it gets down to 2.5%. But in a 2.5% core PCE world, it sure doesn't make sense for mortgage rates to be 3. So the new normal might, be 5, it might be 4. But overall, there's a lot of hesitancy in the bond market there. And the other thing to consider, especially for the remainder of this year, it's already been shown that just because the Fed starts to move rates even a little bit more of a pace than they have so far since the first 50 basis point cut, that doesn't necessarily mean the longer end of the curve is going to come down, right? And so that's going to really be what we're looking at, and that's going to be what will truly move the needle when it comes to affordability. Okay, I'll end with a poll question. First, Where do you think mortgage rates will be over the next year? I'll even say through all of 2026. Do you think we'll get down less than 5%, between 5 and 5.5%, maybe 5.5 to 6%, or greater than 6%? Okay. Go ahead and let those responses come in.
And both questions are the polling question for your biggest concern for your local economy. We've been tracking this for the last year or so since we've been hosting the webinar and tracking either inflation, housing affordability, unemployment, or rising delinquencies. See to be the most concern for your institution.
Yeah. Okay, looks like some of those responses are still coming in. Go ahead and close the poll. Okay, so when it comes to mortgage rates, looks like about a fifth of responders think maybe 5 to 5.5%. No one thinks less than 5%. I agree with that. About 2/3 of you think maybe 5.5 to 6%, and a handful maybe higher than 6%. So, pretty spread out there, but the range of anywhere from probably 5 to 6.5% is highly likely. We're still above 6% today. Clearly, I think we dipped down into the 6.5% handle, but has since popped up a little bit. When it comes to the biggest concern you have for your local economy, about a quarter of you are still concerned about inflation. Half of the room concerned about housing affordability. Unemployment is a concern, but not much for those that are participating in the call today. And rising delinquencies, it looks like a moderate concern for some of you. When we go back into these last meetings here, this slide that just shows the bar chart, you can see the evolution of that. Unemployment really hasn't been a concern on these last few. Popped up a little bit 2 quarters ago. And then, a little bit of a pop this time, last meeting or last webinar that we did in May. We didn't have much concern there. So, there's some changing of these concerns. Clearly, inflation was a huge concern, especially, a few years ago. It remains to be a concern, but home affordability is really starting to increase, as shown by these most recent results. Okay. I will go ahead and kick it off to Leslie, who will cover member financial trends.
Thank you, Drew. To start, we're going to look just some takeaways quickly from the balance sheet side. The challenge around retaining and attracting deposits, it continues. I'm sure you all are tired of thinking about it, talking about it. It's kind of been the ongoing theme now here for a couple of years, especially when the Fed started raising rates. The Midwest has experienced lower year-over-year deposit growth compared to other regions nationwide, particularly at smaller and rural institutions. That's a large percentage of our membership base, and we expect that to continue into the near future based off of what we hear with our conversations with members. And it just may be a shift in the new normal of operating. Loan growth accelerated in the second quarter, despite signs of a slowing economy. Financial institutions, it was across the asset size spectrum, did show solid loan growth performance. Smaller banks did post stronger quarter-over-quarter loan growth compared to their larger peers after contracting in the first quarter. The opposite was true for credit unions, where larger credit unions, they did see a little bit higher loan growth compared to our smaller credit unions. Wholesale funding does continue to remain elevated and fill that funding gap between the asset growth and core funding. There at the bottom, reserve build, it's continuing at credit unions, a little unchanged for bank members, not a lot of movement there, but non-accrual loans, they did move higher in the second quarter. Capital positions improved, but still remain solid and intact across the both bank and credit union landscape. And on these next few slides that follow, we break out trends between banks and credit unions. Banks are across the top, credit unions are along the bottom. And on this slide, we look at loan growth versus deposit growth. On the left side, you're going to see the four-quarter average of loan growth less deposit growth, and the trend compared to where the Fed, where the rate is. And on the right, we have loan to deposits or loan to shares and deposits for our credit union members. Also on the slides, the darker black line, that's going to be our larger institutions, and the light blue line is going to be our smaller institutions. Although loan growth was broad-based, the types of loans that we saw, the growth varied in the different types of loans. CRE lending activity was stronger in our district compared to the broader industry, and also generally stronger at smaller institutions than larger institutions. Auto portfolios contracted during the second quarter across both banks and credit unions. And according to industry analysts, forecasts for the industry continue to anticipate a slowdown in loan growth for many institutions in the second half of this year relative to the first half. And we did see this sentiment also in the Fed's senior loan survey earlier in August. Also, just what we're hearing from members like Drew, our other account managers, it's kind of a mixed bag a little bit of expectations for loan activity here in the second half of the year into the next, a little bit market dependent. Some are expecting moderate growth to continue, while others are expecting kind of flat to even slowing loan growth. And with that being said, we will move to our next slide and the poll questions. We have two on how you would describe your current loan demand. We can go ahead and get those popped open, along with deposit growth expectations for the next 12 to 18 months. And on the right side of your screen, you will see a polling response that mirrors the same question about loan demand from the Baker Group. Baker Group is presenting at our regional meetings, and this is one question that they are offering, or asking, I should say, to attendees there at the in person at the regional meetings. And so it'll be interesting to compare results from each of our states versus what we get today, reaching a little bit different audience. Can wait a few more seconds and just generally looking at while answers kind of continue to filter in a little bit. It looks like the stable loan growth, at least current loan demand, remains stable. And that is very similar to what you see there on the right. And if we want to go ahead and close the poll, we can look at results here for the second question, deposit growth. Moderate growth to about half of you, then flat to minimal growth. I'd say at the beginning of the year during our first webinar, it was a little bit more optimistic, I would say. We did have it's leaned a little bit more towards the strong growth and moderate growth. And that's kind of reversed back here a little bit as we get into the second half of the year. We go to the next slide. Look at a few trends on lending, or I'm sorry, not lending, liquidity metrics, and then wholesale funding utilization. On the left, we look at liquid assets to asset trends versus Fed funds rate. And then on the right, we have wholesale funding utilization. And like I mentioned, you can see that it still remains elevated compared to historical averages and levels we've seen in the past. Liquidity has continued to follow more historical trends for our credit union members, where we've started to see that build in liquidity. And we've seen that now for several quarters there in the bottom left. Top left, banks have been pretty flat the last several years or quarters over the last year-ish. I think some of that is related to within the bank metric for the calculation. It includes pledged securities. Pledged securities have grown quite a bit in the last year compared to historical numbers. About over 50% of securities are pledged within our district for banks. Historically, that's more around 35%. So I think that's holding down that liquidity metric just a bit. We're going to switch to the earnings side here. Continued margin expansion. It was driven largely by the asset side of the balance sheet. The middle part of the curve has remained elevated. It's allowed for reinvestment and growth at more favorable rates. So we see that those loan yields repricing higher, particularly those loans that were originated during the low rate COVID era. Those are repricing higher. Downside, cost of funds, you can see there in the charts on the left, that's going to be the light blue line. They stalled a little bit in the second quarter here after 2 quarters of decline. They did decline again for credit unions, but we're hopeful that that cost could continue to move lower. High cost CD specials, they are concentrated in those shorter terms. 6 to 9 months tend to be the most popular. And the hope is that as those you can shift those maturities into more non-maturity accounts. And as the Fed starts to move rates lower, that lower cost can be realized and cost of funds can start to move down a bit, which will be a positive factor for margins as well going forward. Bond yields are currently at 10 to 15-year highs, provide an opportunity to lock in some yield for those that may have some opportunity on their balance sheet. We are seeing some members look at some leverage strategies and buying some bonds to put on balance sheet. And on credit quality, delinquencies are on the rise, or they're still continuing there to the right in the light blue bars. They were up in the second quarter, but bankers are reporting that credit trends, they do remain pretty solid. Median net charge-off rates for the quarter were stable and unchanged from a year earlier. We saw that within our district as well as nationwide, suggesting that borrowers are continuing to generally pay and that institutions have been effective in managing that risk. Auto loan delinquency ratios, they were lower at credit unions compared to banks in the second quarter. And headlines across the industry noted that CRE delinquencies did drop in the second quarter as banks clean up problem loans, particularly in the office and multifamily sectors. And it was the first sequential decline in delinquencies since 2022. And U.S. publicly traded banks, they did see criticized loans, so those loans that are flagged for signs of weakness, in addition to those that have missed payments. Those did improve in quarter two as tariff-related credit concerns faded, although that does still remain some uncertainty and risk associated with that. And with that, we will move to our last polling question for this section. We've asked this question a couple times before to get a feel for how our what's top of mind for our members. We can get that poll open. On the left are going to be more financial related concerns, and then on the right or more challenges facing your institution. We face similar challenges here at the bank as well. In particular, technology and speed of change, the AI kind of revolution, it ushers in a new era of cyber risk for financial institutions and fraud risk. Our version of succession planning, it might be more in terms of the knowledge transfer from very experienced business partners who are nearing retirement to younger generations. We certainly face a regulatory component as well, along with competition. And we probably could have added another line to this for economic and fiscal policy uncertainty also. And get pretty good response here. I can go ahead and close the poll and see what the results are. Looks like cost of funds, liquidity, and deposit growth dominate the responses for financial concerns facing the institutions. This is consistent with what we noted earlier and what we're hearing from members and reading across the industry as well. A year ago, cost of funds, deposit growth, and liquidity were the highest responses, along as what we saw at the AMC this year. And in terms of top challenges that are facing institutions, technology and speed of change, cybersecurity, and talent acquisition and retention. We certainly understand that given a lot of our membership is more rural-based, harder to attract and retain talent. That kind of goes opposite of the demographic trends that we are seeing. With that, we will move to one more slide and get our special guest, Zach, to join us. Topic on liquidity management. Building reliable access to funding is essential. And we included a couple tables or charts here where you can kind of compare your current utilization and pledged collateral position against your peers. On the left, we have a distribution of collateral that is pledged, the lending value of pledged collateral as a percent of assets. along with that utilization of collateral there on the right. And you can see that pretty broad range of what is pledged as a percent of assets and available to be used to borrow against or use letters of credit and even MPF there on the left. And then on the right, the utilization, about a quarter of our members use about a quarter to half of what's pledged, which means there's quite a bit of members that are kind of holding on to some dry powder and maybe more of a contingent focus as their further use of collateral as opposed to using it for day-to-day liquidity or operational needs. And with that, we will bring in Zachary Thompson, Collateral Review Officer, and have him introduce himself. And he will start sharing some common themes he's heard while he's on the road, as well as share some best practices and takeaways that he has.
Zach, do we have you?
I'm here. Hello there. I'm Zach Thompson. I am a collateral review officer for the bank. I'm one of the people that come to the financial institutions to do collateral verifications and eligibility checks. We also are a resource from day to day that essentially provide the answers to some of the questions that you have and some of the confusion you might have because our collateral guidelines have a lot of information on them. And I thought it would be important today to share some information, some best practices on each type of collateral that we offer for pledging purposes. We have the two categories of collateral. We have the unrestricted collateral and the restricted collateral. Unrestricted collateral means that we do not have any restrictions on how much you pledge based on the asset size in these categories. The two loan categories within unrestricted are your 1 to 4 family residential properties and your multifamily residential properties. 1 to 4 residential includes primary, secondary, condos, townhomes, trailer homes that are permanently affixed, duplexes, triplexes, and quadplexes. This also includes your investment loans, so your landlord loans, and this also includes portfolio loans, meaning you can have multiple single-family loans on a single or multiple single-family collateral on a single-family loan, and it would still be eligible to be pledged in this category. One of the areas that I see confusion about a lot when I'm on the road is about our subprime lending guidelines. A lot of our members automatically haircut some of their loans or don't pledge them because there's some confusion in this area. Our subprime lending guideline essentially says that if the FICO is less than 660 and the DTI is higher than 50%, then it is considered a subprime loan. However, it has to have both of those components to be considered subprime. So if your FICO score is greater than 660 and the DTI may be higher than the 50%, that may still qualify with a compensating factor. The flip side of that is also true, where if the DTI is less than 50%, but the FICO is less than 660, it still may be eligible with a compensating factor. One thing to remember that with investment loans, since likely you are capturing a DSCR and not a DTI, DSCRs must be 1.0 or above, and all single-family loans have to meet our anti-predatory guidelines and also cannot be considered non-traditional, meaning we have to see proof of income or employment, and it must be retained in the file, and we cannot use stated income. The second piece of the unrestricted collateral is the multifamily. So those are your apartment complexes or your collateral where there's 5 or more units. Typically, we see that as loans that have a single legal description instead of multiple legal descriptions for each unit. If you're seeing multiple legal descriptions for each unit, likely that qualifies as a single family and not multifamily. Multifamily also has to have a 1.0 or above DSCR. And for both single family and multifamily pledged in this category, it must be in first lien position. The second type of collateral that we have is our restricted category. These are loans such as commercial ag real estate, seconds, HELOCs, and some of our ag operating and equipment lines. So the unrestricted category is capped at 25% of an institution's total asset size. If you pledge more than that, you'll notice on your QCD that you'll start seeing a decrease in your lending value in certain categories, such as your operating lines or equipment. Before pledging in your unrestricted loan categories, we ask that you exhaust all of your unrestricted first in order to maximize our mission of providing liquidity for the use of home ownership and to promote home ownership. The restricted categories include ag real estate. Ag real estate is probably our easiest category to pledge in. There's only a few things that are really important to understand with our ag real estate. It has to be in first lien position. There is a cap of 85% LTV, and it cannot be vacant land. It has to have some kind of ag purpose. It can't just be a undeveloped piece of land that is going to be developed in the future. It actually has to be ag purpose. Some of our members have pledged things like grounds for hunting. That is not considered an ag purpose loan, and so that may not be eligible. If you have a question on a very particular type of loan where you're not sure if the purpose is actually ag, please reach out to me. We're glad to help you with any questions that you might have. Commercial real estate loans, these are not single family or multifamily. And I stress that because a lot of our membership pledges along the lines of how they do their call reporting. And for investor loans on your single family, you probably report those as commercial loans. With us and our collateral types, single family is single family regardless if it's owned by a consumer or an investor. So in this category, commercial real estate would be basically any of your other commercial real estates besides single family or multifamily. Commercial real estate must have a 1.0 or above DSCR. That can be a global or a project specific DSCR. If it deals in hazardous materials such as a gas station, service or mechanic shop, dry cleaners, it does require a clean phase one. We used to not allow interest only loans in our commercial category. Recently that changed, and I've seen a lot of our members are still not pledging in that category when it comes to a interest only loan. We do allow interest only on our CRE up to 7 years. However, it does require an annual review to be included with that. The next category of lending that we have is our second mortgages. This has the same rules as our single family category. The only difference is we allow it to be in a second lien position. One thing that I do want to point out in this category is that a lot of our members have a home equity product that is an amortizing loan and not a line of credit. And a lot of our members pledge what is a first lien position loan in this category because it's on a home equity and not a traditional mortgage product. If it is in first lien position and it is not a line of credit or a revolving line of credit, it could be eligible in the single family category and not the second category. and it would get you more lending value. So it's very important to understand that the seconds are truly second lien position product, um, and not first lien on a home equity product. So, and if you have questions on that, feel free to reach out to one of us. We'll set you straight. We want to make sure that you're getting the most lending value as possible for the loans that you're pledging. The next
Zach,
category
here.
Yeah.
Just that regarding single 1 to 4 residential real property.
Yeah.
Can it include loans with stated income?
It cannot. That would be considered a non-traditional loan, and that is ineligible for pledging with the home loan bank. We Our proof of income or employment is kind of vast. There's not a single method of collection that we require. It can be W-2s, it can be pay stubs, it could be proof that a direct deposit from a Social Security or retirement benefit or a payroll deposit is made to your institution. We allow for a lot of different methods, including, verbal verification from an employer or a faxed in verification from an employer showing that there's income. We've even allowed in some scenarios leases on investor property to be proof of income, but there does have to be some kind of proof of income or employment for loans to be pledged in the single family category. The next category that I wanted to cover is our HELOCs. Those are your revolving lines of credit on single family properties. This has the same rules as the seconds and the first, except for it allows for a revolving line of credit, and it can be in first or second lien position. One thing that I want to note that we have run across at some of our financial institutions is these loans do have to have a maturity date, and the term cannot exceed 360 months. It cannot be evergreen. That is something that we've seen at some financial institutions, and that is not allowed. There has to be an end date. The next category is single family residential construction. The two things that really stick out on this loan pledging category is it cannot be a spec home. There has to be a contract on it built for someone, or if it's going to be used as a rental property, there does have to be a rental lease already signed for this property. It cannot be a speculative property. The other thing that we have seen issues with in the past is the draw period on single family residential construction cannot exceed an initial period of 12 months and a total of 18 months. So you are allowed to do a modification or change in terms to add 6 months, making it a total of 18. But once it reaches past 18 months, the loan is not eligible. And then for our CFIs, we have two categories of lending that are also offered, and that's your operating lines and your equipment. On operating lines, this must be supported by crops and livestock, and it can be cross-collateralized with ag real estate, but there has to be some kind of crop or livestock on the balance sheet securing this before we will use ag real estate. The total term for operating lines cannot exceed 18 months in total. Change in terms or modifications cannot extend the term past 18 months. So if you're wanting to add time to an operating line, it must be done on a new promissory note. It cannot be done using a change in terms or a modification. And then in our equipment category, these pieces of collateral have to have a business purpose. It cannot be your borrower's everyday driving car. It does have to be something that is actually used in relation to the business. So your tractors, or it can be your work truck if it is being primarily used for the business, but it has to have a business purpose. One area that I run into some confusion on is participation loans. If you are a lead lender, you are allowed to pledge the retained portion of that loan. The only time that participations can be ineligible or is if you're pledging a non-lead lender participation, meaning that you have purchased the participation and you're not the originating lender. Non-lead lender loans could still be eligible. There is a couple of steps to make those eligible. One, both the originating lead lender has to be a member of FHLB Topeka, and both the originating or the lead lender and the purchase lender have to sign some documentation and get approval by us prior to pledging those. If non-lead lender loans are something that you're interested in pledging in, please reach out to us. We'll be glad to walk you through the steps to get that going. One thing that is very important to us is that you are maximizing your lending value, that you're getting the most out of the loans that you're pledging here at FHLB Topeka. Things like pledging single family loans in the commercial category, or pledging single family loans in the seconds that are actually first, or things that are decreasing your lending value with us, and really making sure that you understand the FHLB collateral types versus call reporting type codes is important. If you ever have questions about where something should be placed, do not hesitate to reach out and use us as a resource. There is 4 other collateral review officers on our team right now, plus Deidre, our director. We are happy to answer any question, whether it be a very general or specific question about a loan. Do not hesitate to use us as a resource. One thing that is cropping up in, no pun intended, in a couple of our areas, and including Nebraska soon, is marijuana related businesses. One thing to understand about marijuana related businesses is we cannot accept any collateral where the income is derived from marijuana related businesses. So that could be a strip mall that has a dispensary inside of it. Or it could be, a single use property and there's a dispensary. If we see it on your rent rolls, we can't unsee it. And so be sure before you're pledging your CRE that you are going over the rent rolls and making sure that there's not a marijuana related business there. One thing that I know that a lot of our members hope changes at some point is we do still require wet signature promissory notes. Right now, there is no change in the future to that. So all wet promissory notes are required. Change in terms and modifications can be copies or electronically signed. Just make sure that you are following our guidelines for electronically signed modifications and change in terms. And that can be found in our member product service guide in the schedule of eligible collateral. One addition or side note to the wet signature requirement is we do have an e-notes program for single family loans. These are loans that have to be held in an e-vault. And if you're interested in pledging or understanding the e-note process, there is information on our website, FHLBTopeka.com, in the collateral section of our website. You can also reach out to myself or Deidre Duran-Gray and get more information on how to pledge those. One thing that I look to every time that I go to members is areas in which you could potentially be pledging, or areas that you could be maximizing more. Recently, I had a phone call with one of our members that thought that they could only pledge in a single category. We were able to maximize and get additional areas of collateral pledged so that they could increase their capacity and potentially have the ability to borrow more from us when necessary. this is something that we try to do every time that we come to a financial institution to do a collateral verification. But if you ever have a question about pledging or maximizing your capacity with us, make sure that you reach out to us. We are a resource for you to be used at any time. We are quick responsive, and we are very happy to help you with all of your lending needs when it comes to the collateral side. And lastly, I'm sure that a lot of you are either already pledging to the Federal Reserve, or your regulator has asked you to set up a contingency liquidity with the Fed. The process always starts with the Fed, and they will ask you what kind of loans you want to pledge. Once they deal with their first part, they send it over to us to get a subordination agreement done. One thing that we look for in loans being pledged to the Fed is that they are not loans that are eligible to be pledged with us first. So typically the loans that we like to see included with the Federal Reserve pledging are loans like your commercial and industrial lines of credit, auto loans, consumer loans, credit card loans, and loans to other depository institutions. If that is not enough, we could look at carving out additional areas, but traditionally it is easiest to keep the loans that are eligible to us separate from the loans that you are pledging to the Fed, so that there is not accidental duplication. Because if you pledge a loan to the Fed and pledge a loan to us, and that loan is selected during collateral verification, that loan will be marked as ineligible. So if you have any questions about Fed subordination or the process, Deidre Duran-Gray, our Director of Collateral Research and Review, is your main point of contact, but you could also reach out to any of us collateral review officers, and we can get you started in the process. Is there any questions out there, guys?
Zach, I'm not seeing anything yet, but certainly as we wrap up the call here in a bit and we see anything related to collateral, we can address it. Probably we'll address those questions directly to you folks. If you have any questions for us via email, you can do that way. You can use the Q&A on your screen as well. With that, we'll go ahead and wrap the call today with a section on funding trends. But let's start with a polling question.
You're going to wrap the collateral section.
Oh, yeah, we've got some collateral related poll questions. Okay. First things first, are you interested in more education around identifying collateral, pledging collateral, etc.? Yes or no, pretty simple there. And are you currently looking at ways to increase your collateral capacity with FHLBank? So yes or no should be pretty straightforward.
Listed here, we have another link to the Member Products and Services Guide to provide more information on collateral, lending value detail, and underwriting requirements, as well as a link to the collateral resource page that is on our public site and does include contact information for collateral questions.
Okay. So we'll use those responses to these, and if there is any interest
Looks like
you have in so far as more education, identifying collateral, or looking at ways to increase your collateral capacity, we will reach out to you.
And we do have one question real quick here. Do we have to pledge all unrestricted collateral before pledging any restricted collateral?
Zach, I'll let you answer that.
Yeah, so in the Member Product Service Guide, when it starts in the restricted area, it does say that you should exhaust all eligible unrestricted collateral before pledging restricted collateral. We know that not all of your unrestricted collateral is going to be eligible, so we know that that's not going to be 100% match to your call report. But if we saw that you were pledging heavily in the restricted categories and not so much in the unrestricted categories, and there's some discrepancies between the call report and your pledging, we would probably reach out and ask if there's a reason that you're not pledging in those categories, and potentially work something out. But it's very important that you pledge in those categories, and those categories get the most lending value.
Great. Thank you. Okay, well, now we're going to move on to liquidity and funding strategies. Leslie, take it away.
Thank you, Drew, and thank you, Zach. We are going to pick up where Zach left off here and address collateral positions, liquidity management here for a few moments before we talk about some advanced activity and funding options. Liquidity events can happen fast. Think failure of SVB in March 2023. It demonstrated the importance of the proven ability to access cash quickly and at a reasonable cost without loss of principal. Definition of liquidity is critical. An improved total liquidity position, one that includes both pledged collateral and available collateral, it does help demonstrate solid operating flexibility and a strong contingency plan, particular to your regulators and examiners. Should a member experience sudden deposit outflow, they can quickly backfill using FHLB funding and also utilize FHLB funding to make investments now to capitalize on opportunities to acquire assets. So it does a broader total liquidity position can benefit you from both an operating and contingency standpoint. By optimizing your pledged collateral position, it demonstrates the quick and reliable nature of Federal Home Loan Bank funding to your regulators and your examiners. Building operational and contingent liquidity supports the position that not all powder or capacity at the bank needs to be kept dry. Access to and the utilization of advances or letters of credit provides increased operating flexibility for your institutions. And eligible and pledgeable loans are more valuable due to their ability to convert to liquidity via collateral. An idea to potentially expand collateral may be to consider incorporating this factor into your loan pricing process. Also, when you're booking new loans, having a flag within your systems that yes, this loan is eligible to be pledged to the Federal Home Loan Bank. That might help streamline some processes and allow you to better identify eligible loans that could be pledged to us here at the bank. An enhanced liquidity base, it also provides the ability to better access a funding source with maturities and funding structures to aid in hedging interest rate risk and can fill funding needs based off desired maturities, costs, and risk profiles. Liquidity stress testing. Performing stress testing analysis during good times is when you want to perform the stress testing. You don't want the stress testing to occur during a stress scenario. So it's better to be prepared when the contingency funding need arises. It does take time to pledge additional collateral. Make this part of your near-term contingency process. The identification of additional collateral available to pledge to us here at the bank, along with other funding sources like pledging collateral to the Fed that we cannot accept here. It'll allow you to build a sufficient collateral base to utilize in times of stress. So take time to arrange access to those facilities if not already established. Also, take time to review current policies. They need to fit the process. And policies, they may be old, have been in place for years, if not decades, and could be revisited as the banking landscape, the competitive landscape, it's rapidly evolved over the past few years. So maybe some metrics that have been managed to take some time to review those with your ALCO committee or your board, because flexibility is important. And if you were to start over, what would you do or consider giving what you know today and events that have occurred, in particular over the last 5 years? We at the bank, we do offer a variety of liquidity management tools and strategies. One of them in particular is liquidity stress test analysis, where we look at 3 different stress scenarios: a low, moderate, and high scenario. High would be low probability, high impact. And we look at each of those scenarios and compare it to your pledged collateral position, and ability to pledge additional collateral to the bank, and what that looks like to fill that liquidity need, should one of those events arise, and helps to outline strategies and plans to access additional funding, maybe to optimize your collateral position with us here at the bank, so that if an event were to rise, you can demonstrate the ability to access liquidity in a quick manner. And with that, this is our last polling session for the day. First question is, do you have funding allocated for use both as operational and a contingency liquidity source? So the slide we had before, Zach shared some collateral detail with us. It broke out how much was pledged as a % of assets, and it was a wide range. So the more that is pledged provides a little bit more flexibility in terms of utilizing your capacity here with us at the bank, both as part of your base liquidity strategy, along with having some dry powder for some contingent stress events. The second question is, what are your expectations for advance utilization in 2025 and 2026? We've seen elevated advance balances, particularly in the second quarter. That has continued into the third quarter. So we're interested to kind of get your feedback on what your expectations are for the rest of the year, especially with the poll question on one of the greatest challenges you're facing for your institution is deposit growth. And so that funding need offset with lending expectations, we're here to help fill those needs, and interested in what your outlook is for. We want to go ahead and close the poll. Looks like it's mixed. The majority of you, 3/4 of you, look to use collateral or your funding as with us here at the bank as both operational and contingent liquidity source, which is great. And then the second response, question, advance utilization, maintain or increase. We're hearing that from members. I think there's some sentiment that there are upcoming maturities of advances where there might be a desire to pay down, but just that ability might not be there. I'm going to shift then to kind of what we're seeing, what are other members doing, and related specifically to advances. A lot of members are staying short in anticipation of rate cuts to take advantage of that cost savings, especially on the short end, should rates move lower. I said advance balances have been sticky. We've had mixed activity of members with maturing advances. Some are paying down, some are renewing in the same sort of structure, maybe for a shorter term, and others are replacing with another structure, or they're moving to a SOFR advance and staying short from maturity of a term advance. SOFR advances have been very popular. The amount that have been issued and outstanding since the end of last year on our balance sheet has grown significantly. And the most common term of those SOFR advances are 1 to 3 months. And with that, you can see on the next slide, here just a few highlights or attributes of our SOFR adjustable rate advance. If you've been carrying an OLOC balance, take a look at the short-term SOFR adjustable advance, particularly the 1, 2, and 3 month terms. You do receive a consistent pricing advantage compared to the overnight line of credit, which you can see in the 2 boxes on the right of your screen. The overnight or the SOFR adjustable rate advances, it's received an average benefit of 4 to 5 basis points over the last year and a half. So maybe consider moving a portion to SOFR adjustable advances, can pick up some cost savings immediately. You maintain flexibility to pay down on the line as deposits or cash flows come in, while realizing some cost savings in the meantime. If you have any questions on SOFR adjustable advance, please feel free to reach out. The lending desk has been getting more inquiries on this advance structure. Some other funding advance types to consider are fixed bullet rate advances. So for adjustable, I just mentioned, and then the potable advance. Fixed versus floating funding strategies may depend on the relationship between what the market is pricing in for rate cuts and then your own internal expectations can provide insight on whether or not to borrow fixed or floating. If you expect fewer cuts than the market is pricing in, then locking in a fixed rate may be the path to go down. If you expect more cuts than the market is pricing in, then floating may be a more favorable funding choice. Then Drew was talking earlier about the change in expectations for rates over the last year. And last September, when they were considering looking at 6 rate cuts, you could have gotten some fixed rate funding at a lower cost than maybe what you could get today. In periods of uncertainty, the putable advance, it creates opportunities to reduce funding costs as well. By looking at various maturities and lockout periods, can help align risk and cost on your end. Putable advance activity comes and goes. It's a little bit dependent on market rate movement from day to day, but there are days of volatility where we do see more putable rate activity. If you are interested in looking at historical rates for over time for any of these advances or another, we are line of credit. We are happy to put together some information for you to consider when you're looking at taking down some new funding, or you have maturities upcoming to make decisions on if you want to keep that same structure or look into moving into another one. And along with that, you've seen this slide before. It's a screenshot of our funding strategy illustrations tool that we offer. It allows you to compare various advance types and different rate scenarios. So we can customize rate scenarios based off of what the Fed is currently projecting. We can add more rate cuts. We can add no rate cuts or even rate hikes to see the difference in cost comparisons between fixed rate advances, putable advances, and then rolling SOFR and OLOC funding. We are happy to come join you for your outcome meetings or put together some analysis for you to share with your team to walk through different funding strategies specific to your institution. And then planning ahead, like I said, fixed or floating, we have the ability to run scenarios for you. So please, you can contact your account manager or the lending desk. One thing I haven't mentioned, advanced restructures. These may become an attractive option depending on rate movement by modifying an existing advance that does create opportunity to enhance margin and manage interest rate risk. And then there at the bottom, we do list a couple other strategies to consider. One, and specifically that Drew mentioned back in May, and if you've attended our regional meetings or even AMC, if you have exposure to falling rates, may have some opportunity to anchor in some yield and duration with longer duration bonds. Leverage strategies tend to work best in early stages of an easing cycle where funding costs are expected to go down, but asset yields are still high. If you have any questions or would like to run some scenarios, please reach out. And we will turn it over to Drew to wrap it up.
Okay, thank you, Leslie. So thanks for everyone attending the call. As always, if you have any need for more resources, you jump on our website, reach out to your regional account manager. And we will be happy to help, or you can just jump on the website directly. As Zach mentioned, he's available to you guys if you ever need any specific pointed questions with him or the rest of the team on the collateral side. We've got a lot of arrows in our quiver, so please do not hesitate to utilize them. And lastly, we've got 2 more of our regional meetings coming up. Kansas here towards the end of this month, Monday, September 29th. It's going to be at Colbert Hills Golf Course in Manhattan. And then we will wrap up in the great state of Oklahoma, Wednesday, October 29th at Gaillardia Country Club in Oklahoma City. So if you haven't registered for that yet, please feel free to do so. And we will make sure to get you all set up with that. As many of you know who've attended in the past, it's half-day seminar followed by a half-day golf, and it's always a great time. We've got some great speakers. As Leslie mentioned, we've had Baker come out for our first 2 in Nebraska and Colorado. They've been doing some similar poll questions, sharing some of their internal data, comparing it to ours. We always like to visit with Baker. They're a great resource for our members as they cover much of the same district financial institutions. This is just kind of a reminder of our member solutions tools that are available to you. This is now on our website, so you can see a list of everything that we do. I know it's long. Leslie works very hard with our team to provide a lot of these specialized tools for you, but all of them are certainly available to you. We do not charge for them. It's just a benefit of your membership, and happy to walk you through them, do some illustrations, maybe just hey, this is how other folks are using it, best practices, anything like that.
Yes, and there is a request form at the bottom of the page if you're interested. We are also working on that kind of middle box in the screen, adding some additional detail, where if there would be another page where it describes each of the tool and does provide an example that you can check out before requesting an analysis from us.
Okay, well, thank you everyone for attending the call, and we look forward to seeing you guys at our upcoming regional meetings, next year's AMC, and of course, the next FI Live. Thanks, guys.
Thank you.